Hey, good morning, everybody. We're going to get started here. I guess it's good morning in Southern California. So from wherever you're watching, look, good to see a lot of people on this morning from looks like all over the world. Anyway, my name is Rob. I'm going to be kicking this off this morning. Before I get going, could you just type in a Y into the box to make sure that everybody can hear me? All right, very good, Anthony. Rick, thank you. Hey, so I want to get things kicked off. Again, my name is Rob, and we're going to this morning. Normally, we go through the volatility report. We're going to do the same for those that are new on here. But before I get into that and hand it over to Shane, just a little bit of housekeeping. Want to make sure that if you are new to the program, and a new subscriber, that this program is really set up for us to be able to help you with trading questions and looking at pairs. So that being said, I want to make sure, and just a quick reminder, that if you want us to look at a pair, and Wade and Shane will kind of tag team those, help us with the pair that you want, and then also the time frames, your entry time frame, and then your higher time frame that you're using for your trend direction. And that'll really help to be able to answer the questions that you're looking for. The other thing I want to make a note of for those that are new, if you have a technical question about anything having to do with your software, that sort of thing, please make sure you send those into support@tradeats.com. This program, what we're trying to do is just focus strictly on trading and looking at pairs and really making the most use of our time together. The program will go somewhere between an hour and 15 minutes. And to kick that off, we're going to send it back over to Shane. So Shane, why don't you tell us about the volatility report?
All right, perfect. Thank you. Yeah, so hello everyone. Thanks for being on. I'm going to go ahead and jump into the volatility report. So this got released our time yesterday evening. And the pairs that we chose for this week, it was actually pretty interesting because I went through kind of the way that this works is I go through and I do a scan over basically all of the major and minor pairs, and then a few extras on top of that. But try to see what's going to be breaking out of or picking up in volume moving forward. So I went through, and typically on a regular week we'll have about 3 pairs, but I could only find 2 that looked what I was, good to me. There was a few others that were breaking out of a box, but they had been in 3 or 4 boxes all within the last few weeks, so didn't really want to include those. So the 2 that I've landed on is pound dollar and euro yen. So we're going to go ahead and jump into those and take a look at what's going on with them. So the first one we're going to take a look at is euro yen. So this pair, it was pretty straightforward. I know we've been getting a lot of questions about the master pattern, and we went through and did a presentation. I think it's been about 3 or 4 weeks ago now, just talking about the master pattern on a larger scale playing out here. So I kind of made sure to make a note of that playing out on this pair. We can see that we started this contraction box, and then we expanded high, expanded low, broke through the low of the box, and then settled under this previous expansion line back here. And then we had our final snap down to the short side. After that point, we've went back into contraction. Now we're starting to push up. So we want to be looking for any resistance or, just any turbulence, for lack of a better word, right here around this level. So again, expand high, expand low, and we can see that it's reacting to that previous expansion line right here. Anyways, as far as actual entries in this, looking at it from a daily and an hour chart, by the time that we broke out of contraction, we were up around 116.95, which would be right in here. So we broke out of contraction, then we went into a little bit of a range. The only entry that I see on these time frames is right in here. So we formed a new expansion line above expansion on our larger time frame, below expansion on our entry time frame, and then started pushing up along from there. Although that was a little bit of a tough trade to get into because there wasn't a great way to manage your risk outside of just the low of the candle. So I'm going to go ahead and move it down to a little bit lower time frame. You know, a lot of you like trading the 15 into the 4 hour. Now for the 15 into the 4 hour, so pretty similar through here, above expansion, and then 1695, where we broke out of the top of the box, would be right after we came through this liquidity line. So we popped through the liquidity line, and then we were out of that daily box. And then that would be right around the time that we went into this range here. So this one was a little bit trickier. We formed an expansion line, we're under it, and then pretty much the first green candle that confirmed right here, that could have been a potential entry, but there was not a whole lot of room for a stop. It might have even taken you out if you're managing it off of the low right there. That being said, it was the first candle, a little bit tricky to get in right there. And then we had what looked like a pretty good entry where we got down below the expansion line. So again, above expansion on our higher time frame, below on our lower time frame. Below expansion did not take out a liquidity line. That's always a good sign. But then we went back into contraction, and we find out we did go back into contraction because it had one more snap down to the short side that we were going to go through. Then we came up, and then this was interesting here. We rotated off of this expansion line. That's typically not a great sign. And then we went back into contraction. So all through here, this was, usually it's not quite this difficult. Usually it'll give you something a little bit easier to get into, but that was a little bit challenging to manage. And then of course it did end up going long. So the overall direction and everything was fine if you managed to stick your entry and wait for it. But some of these clues right here, when it goes, most of the time when you see price roll over off of an expansion line like that, especially at somewhat of a tipping point like we were at, that's usually a clue to get out, not to go the other direction, but just to get out. But we ended up popping down and then rolling through it, and that's where it really took off. So kind of interesting. The second pair that I'm going to go ahead and take a look at is pound dollar. This one was very interesting. I'm going to switch back over to a daily into a 1 hour chart. So one thing that I actually brought up on the volatility report is how we were having a reaction to this previous weekly expansion line. So we can see, you know, out of our last weekly box that we had a little while ago on pound dollar, we had you know, a massive run, almost 1,700 pips to the short side. So it was a big run. We went and we can see that we were just headed to take out that liquidity line, judging from the reaction by it. And then came back up, went into contraction, and now we're breaking out of the box, and we held up on that same exact expansion line. So I mentioned that in the volatility report that all things considered, we're under expansion on the daily and under expansion on the weekly as well. But you know, it holding up on that previous weekly expansion line is always a little bit suspect. So you just wanted to pay attention to that. And for that reason, I didn't want to give it a recommendation to just go short. And it looks like that might have been probably the better way to go on it. Anyway, so as far as pound dollar, if you were looking at that it bounced off of that weekly expansion line, we ended up pushing long. We know that when it hits an older expansion line, we're going to go through a little bit of a breath right there. So we went through that breath and then whipped down and rotated right off of this, the most previous expansion line on the hour, did not take out liquidity, and then we had a push up long. So that's really the ideal situation that you see right there, or an ideal entry to get into a trade. And for this one, we'd be looking to take it back over to expansion. So anyways, that pretty much wraps up the two pairs on the volatility report. I see there's a few questions in through the chat. I'll go through and kind of answer some of those and then kind of jump back into them over the rest of the webinar. But anyways, I'm going to go ahead and hand it over to Wade, and thank you, everyone.
All right, thanks, Shane. Thank you guys for being on the webinar here. Just give me a second. I got to get my screen set up, and then we'll get into some of your guys' questions here. So hang on one sec. All right, can you guys type in a Y if you guys can see my screen and make sure you can hear me all right? Just want to make sure we are all set up before I start going into my spiel here. All right, looks like we're good to go. Thanks, Randy, Frederick, Simon, Jerry. Thank you guys. Okay, so usually the way we've been doing the webinars, the layout is while Shane's going through the volatility report, is I'm just kind of looking at your guys' questions coming through and trying to just kind of start picking out some. So for you guys that are new, like my dad said when he opened the webinar, this is the purpose of these webinars is to basically just make sure that you understand the basics of how to use ATS, how to look at the different components of it, and are able to accurately define the market condition and interact with the software. That's what the purposes of these are. So that being said, during this Q&A, what we're looking to do is, if you have markets that you're looking at, what we'd love to take a look at those markets for you, give you our 2 cents on them if you want it. But what we need before we can look at a market is we need to know, number one, the market, the currency pair you're looking at, and we need to know the entry time frame and your supporting time frame. So 2 time frames. Then we can pull it up. If we're not getting that information, then there's a good chance we're going to look over you asking your question, just because we get a ton of questions here, and honestly, it's super hard to pick which ones to address because we get so many on the webinar. But anyway, one of the things I'm going to address, which is an ongoing thing that I'm always having to climb over with new subscribers, is the ATS assistance signals. We had a comment here from Phil asking, he's new to ATS, and basically the question is the signals that he's been experiencing, that they come up and then they seem to just go the opposite way. And the number one, when you're using ATS Assistant, remember, it's just a helper to define a specific market condition. I do not recommend using ATS Assistant. You could pull it up and look at it and just get familiar with the tool, but I don't recommend using it when you're brand new. I would get at least 30, more preferably like 60 to 90 days on the screen, understanding the movement and how it interacts with the lines before you use ATS Assistant. Because I know a lot of people sign up and they just expect that this is going to do the work for me. It's not that type of tool. It's defining a criteria, but when you get those signals, you still have to go through a filtering process and understand the context of the signal, and decide how you want to define, what you want to risk on the opportunity, and how you want to treat that specific opportunity. And some of them, a lot of them, you probably don't want to take just because there's not enough things on the screen working out. But it's a very basic signal that is generated. It's looking at the color of your supporting time frame, the color of the candle, and it's looking for counter trend liquidity timed with the 3 market phases. Now, the question that Phil asked is the signals going the opposite way. The reason why, depending on the market condition, I get some people that get on and they put on ATS Assistant their first day, their first week, and they're saying, I'm killing it. It's awesome. And then I get some people that put ATS Assistant on immediately and they're like, this is crap, it's not working. Nothing's working out. I'm going to tell you why there's such a stark difference. The stark difference is because the person that loaded up ATS Assistant, and their higher time frame was in a clean trending market, and it is killing it. It works really, really well. And the person that had a bad experience loaded up ATS Assistant, and their higher time frame was probably extremely choppy or in a box. They're not doing their top-down analysis to make sure that they, you know, that they're understanding their higher time frame. So, and that's literally just the market condition they go in. But if you go through the course material and you watch our previous webinars, we always talk about you have to understand the higher time frame to take the context to get the correct understanding of those signals from ATS Assistant. If your higher time frame is not in behaving in a way that makes sense that we would want to engage with, then the signals aren't going to matter. You have to wait till that higher time frame is basically almost like you want to just jump in just because you see how it's settling, you see where the direction's headed, and then you look for the signals on the lower time frame. Until that happens, you ignore it. So a situation where if you got the ATS Assistant running and you're like, every signal is just turning around on me, that's number one. The reason why they seem like they're a turning point is because they are. They are a turning point. And the signals, what you're doing is you're trading around a very sensitive point in the market. And that is why the signals, if you manage your risk and you understand your higher time frame, they typically either work huge or they don't work immediately. So you're at the tipping point. But if your higher time frame is in a sideways market, or it's in a box like on the 4-hour, you know, or a trend has already happened and it's likely to go into a box, you're not timing the market on your higher time frame, then every single thing, every time you get a grade A or grade B signal, you're going to feel like it falls apart on you, and that's because your higher time frame is going sideways. You have to do your top-down analysis to understand where you are in the cycle on the higher time frame before you pay any attention to the ATS Assistant. It's just a helper to say, hey, guess what? We're getting counter trend liquidity. Check your higher time frame and see if it's something that makes sense. So I just want to clarify that. And I know it's my fault for allowing access to that for someone that's new, because this is an ongoing battle with that. But it's an excellent tool, but you have to understand the system. You have to understand the market cycles before you can really understand what the ATS Assistant is giving you. It's just chiming you when you're getting that counter trend liquidity, and those are the most powerful entry points, and like especially the grade A opportunities. Those are where you're right at the turn, or you're close to the turn, and if they take off, then those turn into huge low risk, high reward opportunities. If they fall apart, it's telling you something about your higher time frame. So there again, it's a quest for information. If a trade, if you're following the basic strategy and something doesn't work out, you have to start asking questions. Why? Why is this not working out? What's wrong with my higher time frame? Because at the end of the day, if you're going to get follow through on your higher time frame, it's going to keep trending, then all those A and B signals will come around. So it's a real kind of a process of elimination. I got the signal, I'm just forget the signal, I'm just following the basic strategy. I enter, okay, it doesn't seem to be taking off. It's not getting through the expansion line for my target price. Why? Ask questions. What's the quality of my higher time frame? Why is it taking so long? Why is it getting rejected off of the expansion line? You just ask questions and you will come to a conclusion that gives you the true context of the market and understanding you know, what's likely to happen. So anyway, I just wanted to touch on that. Now we got blown up with questions here. So let me see here. There was another question that came from, and I apologize, we got a lot of people from all over the world here with different names and things, so I apologize if I don't say your names right. Forgive me. But I think it's Jano. Hopefully I pronounced that right. Trend at the start of the week and midweek reversal was a question. So basically asking, there's been behavior that's been noticed. I'm not sure the currency pair or the market, but is there sometimes trends at the beginning of the week and then a midweek reversal? Is that common? No. And I understand how it is to get connected to these kind of patterns of behavior. There was an instance for me probably about 11 years ago, 10 years ago now, where I noticed when I trade euro dollar, I would notice that I felt like it went long around, 5:30, 6 in the morning, and that the market dumped off around, the end of the session, around like, 11 a.m., noon. This is Southern California time. And I thought that was just a working pattern. Like, I'm like, okay, that's, it went up 30 pips and it's probably going to dump. But over time, what I realized is I was just part of that cycle of the market. But what ends up happening as traders, we try to connect to, to repeatable patterns. So we have some expectation of how to interact with the market. And you have to some degree. That's what the 3 market phases and what we do here is all about, is about defining predictable behavior or probable behavior, and then interacting with it to basically navigate the market. But to go back to that question, I would be careful. It's, again, you guys could do whatever you want, but trying to come up with an approach that you think that the market does something at certain times, or it's just a characteristic of it. I know a lot of people, like, for instance, they'll trade the London Open. That's a big strategy. And the London Open does have volume that comes into it. That's just a natural cycle of how, how the markets work. But there's all strategies, that are all about trading London Open. And what you got to be careful by forming too big of an expectation that you're going to get an event that happens in the market based on timing. Just my experience, I know that the markets can go through cycles where it seems like, oh, it always dumps right, at this time every day. In fact, I had a friend that we were trading with a long time ago. He spent a lot of money on one single strategy on a pound. I forget, it was a pound pair, but it was literally because he caught on to a cycle. He's like, look, at this time, it always goes short, usually 20 to 30 pips, it did happen for a while, but eventually that cycle faded, and obviously he got discouraged and it was back to the drawing board. And I've seen that working with hundreds of traders over the years, hundreds and hundreds. I've seen people adapting systems and trying to latch on to those behaviors in the market, desperately trying to find something that's predictable and is going to happen like that. And I'll tell you right now, without understanding contraction and expansion in the market, that's really the timing of the market. The contraction and the expansion, and then the trending away from those average price levels that are defined by the contraction zone. That's the only thing that's predictable in my experience in the market, and the fact that markets trend. So if you take those, and these are very basic market behaviors, and that's why they're so effective, is because they're so basic. So if you're trying to time an event in the market, timing expansion, the minute you get out of a box, the minute you get a new white line, if you want to time volatility, that's the closest you're ever going to get. It's not, number one, it's proven. It's proven that it's coming out of the box. We are going to move from that contraction zone. So, and not only is it proven, but when you do those, when you go off of the market's times for expansion, especially in session, if you're trading lower time frames, then you're going to be early to the volatility, whether it trends up or down. But you're going off the market's timing. You're not attaching yourself to something similar to what Janelle said about the trend starting at the beginning of the week, and then we get a midweek reversal and things like that. That could happen, but at the end of the day, it's the cycles that define our timing. That's what we want to pay attention to, because we don't control the market. It's not going to fit into our box of criteria. It's always, the cycles are always going to change. They're going to get bigger. The market can get more congested on the higher time frames. We have to pay attention to the price action, and what the price action sets the rules of engagement. We don't. So we have to just interact to the best of our ability with that and let it tell you the story. Let the story come to you. And when the story becomes clear, then it'll become clear enough to where you say, okay, I got to take action. I've seen enough. I got a good sense of where I think it's headed, and I got a good risk to reward, because at the end of the day, it's just risk to reward. And then you take action. So anyway, I just want to address that. We got a bunch of questions that came in here. Shane, if you want to add anything to that, go ahead. I'm gonna read through some more questions here, and We'll get to those. So hang on one sec, guys.
There's actually a question that I wanted to address. So it was just kind of touching on that the pound dollar, that it's under expansion on the weekly and the daily. And again, you can ideally you want to trade if you're under expansion on your higher time frame, you want to trade in that direction. But after the move is already played out and you can see that it pushed and then it reacted to something, that could be, you know, a major liquidity level where it goes and snaps through it and starts turning the other direction. It could be a previous expansion line where it goes and pushes and starts reacting to that and going the opposite direction. You want to stay on the correct side of your expansion line for that first initial push. But if you see a significant event take place after that push, then you want to test an entry. Again, like any trade, you don't know exactly if it's going to work out. But if you have some clue or something that is pushing that lets you know that that might have been why the market moved in the first place to the level that it's at, then you know that just adds a little bit of probability in your favor to try and take a trade going the opposite direction back towards expansion. So a good example of this would be the euro yen that we've got up on the that all of you can see right here. Going back to the second to last box, we pushed, you know, we formed that box, broke out, whipped long, and then we came short. And at that point, we came right up to a previous liquidity line, and then we started pulling back up long. At that point, you were still underneath expansion, but you see that it didn't take out that liquidity line. You know, it came right up against it. It could have very easily taken it out, but it didn't. So if you see something like that, then that would be something in your favor to increase your probability if you wanted to try a trade going the opposite direction. So again, and it had already pushed is kind of a big factor in that. So again, I'm referring to the daily chart on the left-hand side where it pushed down and a little bit further back, same level. It pushed back, it brushed up against that liquidity line and then pulled back up, and then it ended up rotating off another expansion line to continue short, a little bit to the left, a little bit more. Anyways.
I'm trying to figure out. I was looking at questions, so I didn't really catch what you're on that.
Yeah, no, anyways, yeah, it pushed down to that liquidity line and then it rotated back up long. So yes, technically we were under expansion and you should stay, but if in the event that you think, okay, this is something that that could equal a trade going the opposite direction, you're not just taking it because you think it is pushed too far. You know, there's a little bit more substance as to why you might be trying to trade back towards expansion. You know, another example of that would be the move right before this. You know, we rotated off expansion, pushed up and took out liquidity, that red liquidity line up there at the high or near the high. Yeah, so we took that out and then started turning back the other direction. So there was actually, you know, for every move, you have to assume that you know, the price is pushing to a level for some reason. So if you can decipher that reason, or you have, you know, you can, how do I say this? You can understand why, the whys of why it went where it went. That just adds probability, and then that makes it a little bit higher probability to test a trade going back towards expansion. You don't want to do it just because it pushed. Just because it seems like it should probably turn at this point, but you know, you can quantify why it pushed where it did in the first place. So anyways, just wanted to kind of add that point.
Yeah, with ATS, you're getting the framework, you're getting a consistent, solid architecture of the market. So you're getting the sensitive price levels, and then you wait for it to get to these price levels, and then you try to discern the behavior in and around those price levels. It's either going to go or it's not going to go. So that's what ATS is really just trying to give you these definitive price levels that say go or no go at those levels. And then you could interact with those levels for, you know, with your calculating your risk to reward ratio and also looking at the higher time frame trend. For some directional bias, because at the end of the day, the fact that markets trend is really one of the great edges that you have as a trader is trend following. So you combine the two, you have a solid, stable framework that never changes and a defined trend. now you start to have a platform that you can make informed decisions with, that's not going to constantly be changing, or you're changing settings, or you're trying to find what's the the best tailor fit system for this market. This tailor fits automatically. That's one of the great benefits, is that you don't have any settings. You're letting the market interpret the market. It's whatever it is. Here's the framework. It's all price action. So let me go back to some of these questions here. Question from Mary, talking about, make sure I'm reading the question right. Tuning the ATS assistant for beginners. What I think, there are a bunch of different things, and I purposely, that first version, I left it pretty loose, because again, that was going out to people that have been trading this methodology for years. So it was just a tool to be able to customize and create, just to create alerts for coming to sensitive price levels and specific behaviors in the market that we're interested in. For instance, if the liquidity line, the buy liquidity line setting, if you are trading, let's say, like an hour into a weekly, let's say, and the weekly is clearly long, but what you want to do is you want to build a position in the weekly direction based on liquidity line levels. Then what you would do is that you would have your weekly set, it would just be a chart, and then you would set your 1 hour, and then you would set the buy liquidity line alert to alert you every time you came through a green line, if the weekly trend is long, and vice versa. If the weekly trend is short, then you set it for sell liquidity. Then every time your computer dings, there's a possibility to enter a minor position in the weekly direction. That's a strategy if you're doing that strategy. So that's why it's there. So again, another strategy is if you're trying to trade trending markets and you want a volatility signal similar to what we do on the volatility report, then you would set a box expansion signal. So every time you get that expansion out of the box, you get alerted, and you know that you're early to the volatility. Now, we don't know for sure which side it's going to go, long or short, but you have a volatility signal, and you have a defined average price point signaled by the white line that is your tipping point between long and short on that higher time frame. But the point is that you're early to the volatility. You're not getting a signal when it's already ran 100 or 200 or 300 pips. We're early, and that's half the battle. We just need to figure out where it's going to go and settle, and we're navigating the entries and testing different ideas on the lower time frame at that point. So, but that's what's there. So going back to Mary's question about programming the assistant, it's really flexible to figure out what signal that you want to program to it for the type of information that you need to confirm your trading ideas. And that's why it's, maybe, like I said, maybe just the liquidity line signals are sufficient, and you just turn on the one side of liquidity based on your weekly direction. That's why it's flexible. And then when you get that signal, you say, okay, I'm coming through a counter trend liquidity level, and against my higher my higher time frame, do I want to add to my position? Do I want to start a position? Again, it's just notifying you that, hey, this is one of those decision points. You may want to take a look at it and see if it's something that you want to interact with. That's it. As far as the grade A and grade B trade opportunities, again, those are just looking at the higher time frame color. They're telling you, hey, your higher time frame has just changed a new color, and this is the first counter trend pullback. What that means is, let me look at my higher time frame and see if it's any good at all. Now, if it's already ran 100, 200 pips, and it gives you a grade A opportunity on the first, let's say it ran long 200 pips, and now you got your first red candle on the 4 hour, let's say, and you get your first pullback on the 15, grade A opportunity. You probably don't want to do anything with that opportunity because it's already ran so far, it's probably due for a box. So, just leave that alone and wait till you get a new box. The grade A opportunities that you want to get really interested in are the grade A opportunities in and around a brand new expansion. Those are the ones that you really want to get excited about. not ones that have already ran 200 pips. And also too, going along with that, if you have it running, some people run the assistant on a 1 minute or a 5 minute, 5 minute into the hour. If you're running it, there is no time filter as it stands right now. So if you're trading the 5 minute into the hour using the ATS assistant, you're going to get a bunch of signals that trigger in the middle of the day or after the New York session going into Asian session, but generally the market's flat. So you probably want to just not pay attention to anything that you get through those time frames, because again, you're talking about everything reverses on you. Well, if you're trading in a flat market, there's no juice, there's no gasoline for the fire here. So again, I left it. I know that there can be a lot more filters, and the new version will have filters. It will have filters for that, time filters, all that kind of stuff. But the first version I left loose so that my guys could be creative with it. And I know it's not conducive to new traders. I know that, and it's been a problem, honestly, trying to explain how it needs to be properly used. But that's a reason why it's so loose, is so that you can program the specific component that's working, or that you need, the information that you need to know based on what you're doing. It's just that helper, and that's all it's supposed to be. So anyway, I apologize if some of you guys that are brand new trying to figure out how to use it. This is a long distance race. You guys need 3 months on this screen to really understand how the markets move with these lines. Once you understand the probabilities, you understand the basic strategy to get you started, and you've watched some price action go by, you will be able to filter out those opportunities and understand. You want to know when they're happening. We all want to know when that first counter trend pullback is happening, but whether you take it or not is going to be how you feel about that higher time frame, the supporting time frame. And if you spend enough time watching these and interacting with it, and getting the feel for this tool, you'll be like, okay, this one, I want to go heavy on this one. This is an excellent signal. I'm close to expansion. This one's worth a shot for sure. Or if you get one and it's like, again, like I said, it's 200 pips away from the last expansion line, forget about it. You probably don't even want to deal with that market until you get some new architecture, a new box, new volatility signals, something new to work with. So just keep that in mind. Like I said, it's a long distance race, and it's going to take you guys 60 to 90 days to really get your feet on the ground, especially if you're new to trading. There's a whole I think feel that you develop with price action. Forget looking at ATS or any software or anything, just feeling how the markets work, understanding when the markets are flowing, when they're not. There's a feel that you develop over time for that, and there's no way to learn that other than just going through it. And it's something you just develop over time. But anyway, let me get back to some of your questions here. I know we got some markets. So one of the questions we had before is Euro Yen still a good long trade? That's why I originally pulled it up. So right now, it's expanding on the daily. We're moving up. Let me jump into the 4 hour. Okay, so 4 hour is pretty extended. We've just come through this liquidity line up here. So let's look for the master cycle. Let's see where we're at. Okay, I see it right here. The swing highs, swing lows to me are pointing back to this box right here. So we had out of this box, swing low, swing high, right? So there's a full expansion back and forth. The low and the high are pointing back to this as the sensitive point of origination. And now I see that now we had another swing low that broke this low, again, still pointing back to here. Now we just broke this high. So you guys see the big expansion range. This tells me that we're probably we're probably going to have some significant movement coming out of this, because this is so mature. But this right here, this level is really the tipping point going forward. That's the most that's where we're ultimately going to get a big deviation from. It's going to go long or short from there. So in a situation like this, since we are so mature into this overall expansion that's going on here, we have another one that happened within here. You have a swing high, swing low, swing high right here. So this was another sensitive point, but you can see this is at the same general level as this other master expansion back here. So would I keep trading this long? Yeah, there's not really any reason why you can't, other than if you're trading a 15-minute, we are getting out of session, out of volume right now. So if you're going to take any trades, there's a good chance the market could go flat on you. So that's something you want to take into consideration. Right now we are below expansion. The last possible entry you had was right here. So if you got in long, you got up through expansion, that was a good sign. We took out liquidity and had a big reaction. So again, we got to just interact with what happens as it happens. It's real time. Nobody can predict the future. I can't predict the future. I'm pretty sure nobody on this webinar can. But what we can do is take probabilities and risk into consideration, and then we can interact with that as it happens. If you trade long, obviously we're long right here. We're above expansion. If you're going off the basic strategy, forget the overall analysis I did. That's the basics. You're above expansion. It has deviated quite a bit away. But this was no doubt a grade B entry signal, would have been along the lines right here. So taking this rotation up above here puts you into the money. Grab that liquidity line, had a big reaction. Honestly, that's probably a break-even trade. It had a chance to perform right here when you got through that expansion. If it was going to be a performer, it would have got through that expansion. It would have held above, got through this liquidity, and it would be in a run right now. The facts is it's not. But by doing the basic strategy and getting in at the rotation, or getting in, you're long over here, you're below expansion. This is a strong entry point. It's a strong entry point. So even if you're going to have break-even trades, it's much better than entering up here where most people are. They're going to enter, even brand new traders, they'll jump in right at this liquidity line because they feel like, oh, it's really starting to take off now. That's the worst entry. The strong entry is down here. When you have a strong entry, you could defend that position and you'll be able to hang in there much longer, even if it doesn't work out. Whereas if you get in above expansion and it does this, now, honestly, you're not going to know if this is a good trade still until you get back through this line. That's the decision point. So entering below the line, the confirmation that it's working out initially is getting back through the line. So there's, number one, get the strong entry. Number two, confirmation that it's working out, get through expansion. Number three is progression. This didn't have number three. There was no progression. We took that out, it reversed. Now we're back at this line, it's getting through, you're done. So if you entered here, you're getting out here, forget it. Now we're down below again, right? And we're down below, we're going back down to this low. If you see on this, we're forming that overall master pattern right here. You had a high run right here, a low run here. Here's another high run. See how it's just widening out? That's part of the pullback. That's part of the pullback, how it works. It's just a miniature cycle with inside the trend, but we have a long bias. We're not trying to rip any of this short. We're only long. Again, if you want, I'm not telling you what to do. This is another potential long entry right now. You have clues. What are the clues? Well, we're still long on the 4 hour, right? We still have a green candle over there. You just took out liquidity. Now in this trade, your initial, if you go long here, again, I'm not giving trading signals, we're not doing that, but for teaching purposes, if you go long right here, right now, what needs to happen? Well, what needs to happen is that you need to get through this line right here. You got to get through that line. So from here to here, this is your strong entry point. This is where you're going to find out if the trade is worth anything. If we get through this line, well, guess what? You're in the money just figuring it out. That's part of that whole 95%, 95% get you in the money. This is just going to get you into the money, but that does not mean the trade is over. You may be in the money on these trades and close a trade because you found out information against the idea. So if it gets up to this line and you get a strong rejection from that line, scenarios right here, let's walk through them. You get up to that line, it's rejecting. It doesn't want to go through. Okay, that's information. All of a sudden you get a rotation off. Now what? If you stuck the trade here, you saw a profit on it here, it doesn't go through that point, and now it's rotating down and now you're back at break even. Do you stay in the trade? Do you just wait for it to go down here and go against you and take a big loss? No. You knew the trade was either go or no go at this level. You have the sensitive point. Now let's talk about if it never takes off. If you enter here, controlling risk on this opportunity, the last level of structure is down here. So this is not a good enough risk to reward just to get into the money right now up to here to let it come all the way back against you down here. So therefore, you really have no choice. If you're trading smart, you're going to have to control your risk basically under this low. You don't have to. Again, this is your guys' decision, but this is just thinking critically about the opportunity. This opportunity happens 50 times a week on different time frames, different pairs. This is a constant thing you're going to be going through. You've got to walk yourself through the process of how am I going to interact with an opportunity like this. So if it doesn't work out, I'd be cutting it right here. If it does work out, here's your decision point. When price gets to this level, start asking questions. What needs to happen? If it gets through, guess what? That's a great sign. Now we got to get up to this liquidity line right here. But by the time you get up there, you're decently in the money and you have a strong position. So we're going to see, and if it holds above, you'll see that it gets through the expansion line. Maybe it goes sideways, but it's staying generally above that, the candle bodies, and then boom, it moves up. That's the progression ideally that needs to happen. Do I know if it's going to happen for sure? Heck no. I have no idea if it's going to happen. But what I do know is that you have a sensitive point, a reaction point that you can put together the pieces in real time. What ends up happening, why people take losses initially, is that they get in on these trades, they get the clues, they don't understand the clues, they ignore the clues that it's not working out, and then they'll ride it negative all the way down to here. And then when they can't take it, it's pushing their pain threshold so much, they just dump the trade, and it's over. It's a booked loss. You're going to have a lot of break-even trades trading this type of methodology, especially just trading the basic strategy. Because at the end of the day, we're reacting to those sensitive reaction points. We have no control over how far the market moves or when it moves, but we can react accordingly and interact with the sensitive price levels. And that's really all this is about. So going back to the question, do I still think this is a long trade? This is an opportunity. It's a grade B opportunity. You need to take into consideration that if this does not work out right here, if this trade doesn't come up through here and turn into some good progress, you do need to remember that you just broke through this high, you're at a liquidity line level, we could very well get a reaction. So putting everything together, if you don't get up through this level and it starts getting rejected off of that, then you need to start asking questions. Why? What's wrong with my higher time frame? Because if the higher time frame is going to have follow through, guess what? That price is going through that line. 100%. It's going through that line and it's going to go in a run. If it doesn't get through, you're seeing the inside. This is the inner workings of this candle and this candle. You guys understand that? Ultimately, at the end of the day, we just want our higher time frame to keep going higher on the 4-hour. That's our directional bias. But you're seeing the inner workings, the inner architecture of those candles. So if you're not getting through this level, it very well may mean that guess what? This 4-hour is about to go red and go into a breath. If that happens, do you want to be stuck in a long trade going down to here? Because you're probably going down to this level right here if that turns red. You have those clues in real time before it ever happens. And that's what it is. A trading ATS, trading the market phases, is nothing but exploring a scenario. You say, I think this is probable to happen. And I think that if it doesn't happen, I'm going to know at these specific levels. And then when you know those specific levels, you can calculate your potential risk to reward. You know that if it works out, that's the power of the grade A opportunity. You're right at the turn. If it works out, you're going to knock it out of the park. If it doesn't work out, you're going to know right away. Hopefully I haven't confused you guys too much on that. But this really doesn't have to be complicated. You're actually dealing with some very basic concepts. It's either going to perform or it doesn't. And you have that tipping point. So how the market interacts around those tipping points is the clues. Just constantly keep asking yourself questions. Even on your entry, You think, I think the market's going to go long on my higher time frame. Okay, well, that's a trading idea. Do you know if it's going to go long for sure? No, but you think probability says it's probably going to go long. So that's my idea. Now I look for, on the lower time frame, clues that reinforce that idea to the point, so much so that you end up taking action. You look at that minor framework on there and see, am I getting clues on the lower time frame that reinforce my idea of what's potentially could happen on the higher time frame? It's an easy yes or no. I'm either getting the right clues or I'm not. So if you ask enough high quality questions about the trading opportunity, you're eventually going to uncover that you're like, yeah, this thing's getting ready to work out. Sorry, I got this thing popping up here. So let me go through and check out some of your guys' questions here. Shane, if you got anything to add to that, go ahead. Just give me a minute, guys, here. I got a lot of, there's probably like 20, 30 questions that came through on that. So let me try to pick out some good ones.
There's actually a theme of one. We've gotten it from a few different folks, asking just basically how you would time the entry on this. Would you get in at the first green candle that we've got right here? Would you wait for the candle to close? Would you wait for, just how would you kind of manage this exact opportunity that we have right now?
Okay, yeah, so this opportunity, let me see. I'm just waiting for the candle to close. There's a fine line. I know that there's always, you guys as traders are always going to be fighting a fine line between confirmation and good quality trade placement. You're always trying to find a middle ground. The best trade placement in hindsight is going to be ripping the tip of the wick like this right here. That's in hindsight, that's always good. But at that moment, you feel like it's a falling knife. So the compromise between this and the confirmation of the candle turning is finesse. I don't know how any other way to explain that. So this one, what I would look for in this situation, just the way I generally feel about it, is that you're getting the rotation. Probably the minute you turned green and then you got above, you broke out of these higher wicks, just the way this is forming would probably be enough for me to be like, yeah, this is probably good to go. And then let's see, let's enter the trade real quick. If you're going up long right here, let's say you bought like that, this is a little too late. Ideally, you'd want to get it right down here at the rotation. But, in this situation, if you're late too, I'd probably stick your stop loss right there, just because it's above these active highs right here on these last candles. I pretty much would be expecting that we're going to make immediate progress. And if that progress doesn't happen, you got to start asking more questions about the quality of the setup, or you need more information to come to a better conclusion. So if you're entering right now, that's probably where I'd hit it. And again, you guys need to adjust your own money management, what you want to risk on the opportunity. That's your guys' decision. You shouldn't generally risk anything more than 1 or 2% per trade, per opportunity. I think those are good rules. Those are not my rules. Those are just general good market behavior that anyone will tell you. So figure out what you want to risk on the trade. Based on that, there's your opportunity. And again, the goal would be to get up to here. You want to get up to here, right? So initially, I would put my stop right there. If I was interacting, I wouldn't be waiting because the candle hasn't closed, but it's already in progress. So like I said, I'd be looking at those candles previous. If it jumps past them, probably just pull the trade right there, good enough. And then, probably stick your take profit up here at this liquidity line, because that's ultimately kind of where you want to get to. Initially, that's just kind of where I would go. And sometimes the reason why I'd stick my take profit up there, and maybe even you want to put it up here, it doesn't really matter because you're probably going to end up not using that anyway if you're monitoring the trade. But what I like to do is, just in case, every once in a while, especially when you're trading in trend, is you get things that just boom, they just explode. And what you want to do is you want to make sure, sometimes they'll explode and you'll be up 30, 40, 50 pips, and then it'll come back on you 20, 30 pips. So I like to kind of just set my take profit to a place where I think if I get a random market spike, it'll close me out with a pretty good profit. But again, this is not one of those things where you just want to set it and walk away. These things, you should be moving these around as you get new architecture. So right now, this is just the initial, here it is. This is where I'm going to put it. as you get through, as this candle comes up and it gets through this line and you're in the money, and then especially if you start holding above this line, then you'd probably take your stop loss and move it from here up to here, because now the trade has progressed. And the information is that if you get above this line, now in order to make true progress in the trade, you really need to stay above that level, and there's no sense going back below it, right? Because if you get back below it, what does that tell you about here? Well, it's probably going sideways, or this is about to fall apart. So you're getting those clues as it happens. So that's generally how I would approach this particular opportunity. I really wouldn't wait for the candle to close the way this is formed. I think it's already showing progress. You know, there it is, and it's going to be what it's going to be. But again, this is just for example. This is not a trading signal. You guys can trade what you want. You guys take responsibility for that. But this is just for educational purposes. This is how, you know, how I'd approach this specific one. Anyway, let's keep looking at questions here. Hang on.
I wanted to throw one thing out there, just a little point. So this whole trade is based off of it pushing down, taking out that liquidity line, and then rotating back up to the long side. And I'll get questions all day long about how to manage your stop, and you know, what's a good stop number. You know, should I do 10 pips or 15 pips? And it's all based off of, you know, the whole premise of this trade is that it took out that liquidity line and now it's starting to turn. So we're kind of expecting it to stay above that liquidity line. If it goes below it, it falls apart. So kind of working backwards into that, the closer you get to that liquidity line, the less risk you have. So it doesn't have to be this arbitrary number, and it goes across, you know, goes for everything. If you have a rotation off an expansion line that you're basing your trade off of, the closer you enter to that expansion line, the less risk you'll have in that trade. So again, we're working off of these different levels. So the closer you can get into them, the less risk you'll have, which opens up the world to you. That's when you can start, you know, doing some of these trades that are technically, you know, testing it back, a trade back towards expansion. If you want to test that and you have like 3, 4, 5 pips of risk, that suddenly becomes a viable option that just to test a trade, because you see some things that might make you think there could be a potential turn, but you know, just keeping it real low risk and getting in close to those potential turning points.
Yeah, that's a good point that Shay made. This is the idea behind a trade like this is the fact that we grab this liquidity, and that this liquidity is going to be used possibly to further this trend. That's the inner workings of it, right? So if that idea holds true, what needs to happen with this liquidity line? If price even comes back to here, if the smart money accumulated bargain priced positions at that level, do you think they're going to want to take it much below that level? No, they're not. So again, it's a series of questions. What needs to happen for this trade to work out? What needs to happen for it not to work out? If you answer those questions correctly, you will have what level of stop loss you need to use, and you will have a general price target for your reward. And if any opportunity, if you're answering those questions and you're like, this isn't very good, it's probably not a great opportunity. Again, it's to come down to the quality of the questions that you ask yourself about a specific setup. And then when you answer those and it's very clear to you, you've thought through the for better or for worse what the outcome of the trade, then you can make a quality decision on whether you want to take that trade or not. If there's not enough good things, good answers to your questions in your favor, then wait till there are. Okay, question from Phil about what previous webinar covered the ATS assistant. Honestly, Phil, I'm not sure. We didn't do a very good job of labeling those. I apologize for that. I think it's probably not more than, I don't know, 6 webinars back, I would assume. So I apologize. I can't get it better than that. But I do touch on it, you know, off and on throughout all the webinars. It seems like there's always a question about it. Okay, so let's take a look. We'll take a look at Euro Franc here for Gary. Hang on, I gotta find it. Okay, there it is. Okay, Euro franc. Well, we had a big spike, that's for sure. This off the screen. This looks like a wild ride. That's what it looks like. You know, typically, just again, this is just my opinion. When I see things that are just these huge spikes like this, obviously you're long. You know, you want to be going long to have your directional bias. But this is pretty whippy. Honestly, I wouldn't be trading this pair much right now. You know, we had a really tight contraction phase come through here. You had a big explosion. You know, I just tend I like flowing movement. I like movement that's just it's flowing, it's opened up. This tells me that we had all this tight movement tells me that the higher time frames were probably contracted. Let's take a look at the monthly to really work our way backwards here. See how that feels. Okay, so the monthly, you're getting a big kind of consolidation, contraction going on because the monthly is starting to go sideways here, and you can see that we just took out this liquidity line level. So what ends up happening is that it's trying to figure out, are the fundamentals about to change for this currency pair on the higher time frame? And they probably are. It's actually probably getting ready to go into a really big move, but it's still dealing with a lot of noise because of we're at this decision point. So, you know, I would probably, you know, like I said, I would stay away from this pair. You really want to trade stuff on the higher time frames that's fresher on the expansion. So, like for instance, like this. See, we just had this big rundown. This is beautiful. You knew you had the volatility signal on that candle. When you broke out of the box, it rotated. You got below expansion. See, like Shane was talking about, your risk, your those decision points. You're close to those expansions. That's when you'd start trading the short. And there was a lot of meat to get out of this. You know, even up here when we settled under this expansion level, even in these whips, there was some good meat to get out. But that's really what you want to trade aggressively around these areas of the chart on your higher time frame. And then as you deviate away, you want to start scaling back. You don't want to risk as much because you're potentially getting into chop, which is what we're dealing with right now. So again, this is one of those situations when you approach a market, look at your higher time frames and say, how far have we deviated away from the last expansion? And if we've significantly deviated, this one you almost want to wait and just wait for the weekly to form a new box and then break out of that box. That's going to be the new sweet spot of navigating this pair. That's when the market's going to really start flowing again. So I don't know for sure. It very well may keep going long another, you know, 500 pips. I don't know. But just generally, what I do know is that we have a choice what we interact with. We have a choice of the markets that we want to pay attention to. And I find it's best to really pay attention around these breakouts and the sweet spots, and to pay less and less attention the farther we get away, because it's just, there's a good chance you're going to go into a sideways market and get beat up. And that's, to me, is what this looks like. You know, so I would just be careful in a market like this. Okay, let me keep reading.
Real quick, I just wanted to add, as far as that exact setup right there on the 15-minute, when it was pushing up, and then, you know, we never had in those three higher highs that we had, you know, none of those were ever under expansion, so you wouldn't really be messing with any of them. But then we came all the way back down, reacted to the lowest expansion line, took out a liquidity line, and then started turning back up. Technically, that would be your time to test an entry on something like that. The market in general, this market in general is pretty whippy, like Wade said, but that would technically be the time or where you'd want to test it. We were under the most recent expansion, and then we had a little bit of extra clues in that we reacted to the previous expansion line at the low and took out a liquidity line. So, you know, you're stacking probability in your favor, and you also have a little bit more substance if it goes against you, instead of just getting in kind of randomly. You know, the premise, like we were talking about on euro yen, I think it was, the premise is that it's going to stay, you know, above that liquidity line or above that expansion line. So, you know, if it falls apart and goes under that, then you have more reason to understand that it just wasn't, you just weren't correct about it, instead of endlessly trying to test the trade again and again if it goes against you. So
Yeah, and just working through this one we had kind of a box inside of a box. That's why it got blacked out here, because of MetaTrader, the code doesn't allow you to layer 2 boxes on top, so it'll black out part of one. But what ended up happening is that as you broke out through here, there really wasn't an entry for this one right here because you were still inside the box. So this one broke out short. The first entry possibility was right here. You know, if you want to wait for the confirmation of the rotation, it was right here. So if you entered long based on the fact that everything's long, going off the basic strategy, then you, again, this is one of those situations, your last level of structure at this moment is down here. So there's no way you're going to risk getting in the money, because at this point you're just shooting for this line right here, this level right here. So if you're going to buy this opportunity right here, you're pretty much, your risk to reward at this point is basically, you know, around these lows, stop probably in here. You really have no choice, because you're not going to know if it's wrong or not until it starts trending lower from that point, which you'll know for sure here. So if you bought right here, stop goes down here, and then your initial risk is up here. So that's almost kind of a 1-to-1 situation, risk to reward, just getting in the money. You got to decide if you want to take that. But in this case, the trend did prevail, even on this one. If you entered right here, stops right here, you're trying to get up through here. Yeah, you had to sit in a sideways market, but it didn't take you out, and you got up through, and you notice that you got more architecture along the way. You pulled up, pulled through. This is technically another entry right here, if you wanted to get in right here, because you're still, your higher time frame still intact, and then you come up through, and then eventually this initial trade does come through. The facts are, if the long market stays intact, you're coming up through this level, and you can see that as you came up through, you built, see it held up on this one, and then boom, you built momentum through that level. That's a great sign. That's a great sign, to the point where you could, in a situation like this, if you're used to looking at this, you can look at this right here. Let's say you didn't enter right here, right? But you know that if the long trend stays intact, we're coming through here. But you're just kind of watching this go by, watching it go by, and then you break down right here, and then you see, okay, now I'm seeing this turn right here. Even if you don't get in right here, you can buy right here. You may be asking, well, but isn't that against the rules? Now you should have gotten down here. No, it's not against the rules, because you're still under this expansion. You're looking at all the boxes, they all work together in an expansion range. So you can buy, because this right here, it's showing you that you're getting momentum up through this line right here, through this expansion line. You can buy a situation like this and control your risk right here. Because again, putting the clues together, it's showing good momentum through an expansion level, which is in favor of the existing trend. And if it's going to be good, it's going to hold above that level. So therefore, it makes sense that you can enter with your stop loss right here. And then as you go up through, your profit target is still the initial expansion level, whether you entered right here or you enter right here with this confirmation. Doesn't matter. This is still the same price target. And you notice as we get through there, it built significant momentum. We came up through the liquidity lines. You know, this is its chance to perform. And up here is just finesse, how you want to get out. That's all finesse on your guys' part, how you want to interact with that. But that's how you would work an opportunity. If you don't have enough architecture, wait for more. You may have not wanted to rip the long right here, but as you said, you're like, I'm just going to give it more time, give me some more levels to work with. But this was, that made sense right there. So again, I know it's more difficult to do in real time, but these levels, these aren't repainting. I mean, this was all there. This all happened, so you're looking back at what the actual deal was. But anyway, overall, the market, I don't think it's that great in general, just because of how much it's already deviated. Like I said, this is just for the sake of conversation. This is how you navigate a bad market. It's all the same thing. You're either going to get clues in your favor or clues against what you want to have happen. So, that's if it's a bad market, you'll find out quickly, because all your clues are not going to be in your favor, or everything's going to fall apart. And in that, you need to start asking questions. What's the deal with my higher time frame? Why is my higher time frame not following through? And you'll eventually come to a conclusion that makes sense. Okay, going through
Hey,
a few
wait,
more.
can we go and take a look at Aussie dollar real quick?
Yeah, we can. What time
Do a
frames?
top down on
Okay,
it. I top down.
all right. Okay, we'll start with the monthly into the daily. Okay, big spike down. So let's look at the monthly deviation. You know, this was obviously all this was short. So if you traded any of this, you were short. Under expansion right here, plenty of trending opportunity, pulling away all the way. This was a pretty aggressive move right here. And now we got a green monthly candle. So, you know, from a monthly standpoint, if you're trading like a grade A opportunity on the daily, let's see if that has triggered yet. I don't see one that has actually triggered yet. So there's actually a good chance that this could actually retrace because it's not sometimes when you get, if you're not getting a grade A opportunity, as this turns green, and see how we're just coming out of the tops of these boxes, you're not getting any price action below really. That's a chance that they're just pushing the market up and that we're going to come back down probably to this level, possibly. I don't know for sure, but just when they're driving a market up and ignoring the bottom of the expansion range, it's usually for manipulative purposes. They're just pushing the market, getting people to jump in long. So something to take into consideration. I don't see any trade on this time frame right now. I don't see anything. So moving down, let's go to the daily, into the hour. Okay, so right now we're just breaking out of the box. Now, if you're trading the daily as your directional bias, this starts to get interesting. We're fresh out of the box right now. There's no setup on the hour. But what we do know is we're fresh to some new volatility here. And the reason why this is so significant, by waiting to trade pairs that are right at this sweet spot, you've avoided all the box. It's like, for lack of a better term or analogy, I'm not a gambler, but if you're walking through a casino, if you knew every machine that someone had fed a bunch of money into, and you knew like the probability that this machine is going to pay out is right now, that's what the boxes are. The boxes represent the machine accumulating money, and the expansions tell you, hey, guess what? You play this machine, it's about to pay out. Now, we don't know if it's going to go long or short. It very well may reverse, but we do have the decision point of the expansion line. So whether it reverses or it continues to go, you have the parameters to work within. But you've avoided all of this chop, because guess what? All the other traders that are trading this market and trading anything and everything, and their range trading strategies and their trend strategies, they got beat up right here, and you avoided it. And now you're about to get aggressive when it becomes much easier. It's timing, the timing of volatility, the whole point behind the volatility report. So this is a very interesting situation, but again, you're going to want to wait. In order to figure out what's inside this candle or the next daily candles, you need architecture over here. So I don't feel good about jumping into this trade long, especially looking at the hour. Now, it very well may keep going, and it'll do what it's going to do, but I don't feel great about jumping in long just yet. I need to see something. This needs to tell me, give me some white lines, give me some boxes, give me something to work with over here so I can start to begin to calculate risk to reward and probabilities of what's going to happen in the next 2 or 3 candles on the daily. But what I do know is that this daily is getting ready to move. So that's your first big clue of information. This is when this is when it's time to go to work. You go on vacation when you're in a box, it's time to go to work when you break out of the box. This is when it's time to start babysitting the pair. Same thing right here. Out of the box, you knew it right here. Again, out of here, you knew it right here. Boom. Under expansion, all trending days. Red, again, under expansion, huge trending days. That's when it's time to go to work. So let me go down to, we'll take it to the hour, into the 5. Okay, so navigating Just because there's no hour setup doesn't mean that the 5-minute and the hour is not setting up. Some trading opportunity going on right here. Pushed up long right here. First opportunity below expansion, boom. Rotation, there it is. Now this is a little, mature for this run. You can see that we've expanded, but again, the grade B opportunities can work, providing that you're in a trending market. You have the daily on your side. If you want to back up the hour with the daily, if it's falling in line with the daily direction, that's even more of a reason to say I want to, stick to the long side. But that's pretty classic right here. Remember what were we talking about with euro yen? The rotation. Now what needs to happen? We got to get up to this line. There's our defined level. That's our decision point. We got up to that level. Sometimes it will go sideways, but you have a strong entry point down here. You had the strong entry point. It gets up. Now we're flirting with the line. The expansion, it gets through. You see it breaks through, starts holding above. Boom. You knew the decision point back here. Got through the liquidity, and now you're just trying to book as big of a profit. This is the part that takes finesse right here. But it all originated from a strong entry point and a directional bias, which is clearly long, green above white. So let's see how that started out down here, because I'm interested. This is really where, again, if you're trading the hour, this is just bonus round up here. This is where it was where you really wanted to get aggressive because you're still close to the expansion. So going back, looking at that, let me see. 5:18, 1 o'clock. Okay. Yeah, okay, so this is coming out of the box right here. So your first opportunity out of here was right here. This is when you expanded out of that box right here. Below, first rotation, that's how subtle it could be. But that's what legged you into this trade literally right here. That's the grade A opportunity. You're gonna know if this didn't work out, you would have got the grade A signal. Bling, comes across your screen. Guess what? Come take a look at me. This may be an opportunity. It's all it's saying. Right there, you see, okay, I'm breaking out above expansion. I'm close. This is a grade A opportunity I want to pay attention to. In fact, I'm probably going to enter. And guess what? If it doesn't work out, I'll cut my loss right here. And if this doesn't work out, this whole thing will probably collapse right away. And that's where you guys say the grade A opportunities are not working. It's like it goes in the opposite direction. That's because it is a decision point. It's like it's the first signal that if a trend is going to follow through or not. So it's good that they fail right away because it's giving you information telling you, guess what? The higher time frame is falling apart. It's probably not worth anything. You know immediately. If it does work out, you're early. You're early to that. You guys see that? And I know that is much harder to do to stay in a trade like that. But the point is, with the grade A opportunities, you at least have the option. So, and then the rest were grade B. Look at a situation like this right here. If you come down through here and you enter on this trade, I know this is where it gets a little difficult right here. One thing you got to look at too is that let me see, because if you're trading the 5 in the hour and your supporting time frame, the hour turns red, that's something you need to scale back a little bit. So I'm pretty sure that was this rundown right here. Now you may not have known that right here, but let's say you went long right here, because that technically, there it is. That's the basic strategy, right? You go long right here. There's no way you can really control your risk, but like down at this low, you're probably getting stopped out on this one right here. And let's say you even enter again right here. And then you get, again, controlling your risk, 2 stop outs. I know it could be discouraging. I know it can, but that's what you got to do to test the entry. What you don't want to do is ride it back to this level of structure, because what ended up happening, even though it pulled the hour red, which once this hour goes red, you really don't want to mess around with it. You want to wait till you get green again. But the fact that it started going red, this is still showing you the inner framework, even working back with this box. Let's see how we came back down right into this level, expansion level here, expansion level here. It actually held this exact expansion level to the tip of the candle. But that's where we go back, those previous levels of structure, it retraced all the way back. So if anybody jumped long in this market right here, guess what? They're still holding on to it. It's going to take it all back. Because this is, if you entered long up here and you didn't close your trade, which is what most people do, good chance you're going to be out of the money. The strong position was down here for this move, right here. That was a strong position. First one below expansion, get up through, boom. But anybody that entered up here, good chance you're going to get retraced and it's going to get taken all back because it's not a strong position. So anyway, this retraced back here. And then let's look at the candle time right here. We come back green on 5:18, 10 o'clock candle. So let's find that over here. Okay, right here, going back green. So here's your green up through here. So this just means that we're turning green, right? We're not just going to jump in. So especially on this spike right here, you may have wanted to jump in. Honestly, you could jump in right here because you're still trading against this line. So I take that back. There was a reason to be made for taking a long trade in here. You know, but it just depends on how you felt, because basically you're just jumping in on the rotation of this green candle at that point, which is, it's doable, but it's difficult. So now that you're confirmed green, you're going up. Now you've entered a new cycle, a new rotation. You're pulling away. Now it's like, okay, I almost feel like I want to jump in, but no, let's wait. Let's wait for an opportunity. Boom, right here. Expansion right here below. Long right here. Control risk at the low. Even though it went back on you right here, if it's in a hold, if it's in a hold intact, you got to be able to live through that. If you entered right here, you could have taken it. If you gave it a little more time, could have entered right here. Or as the same situation like we just had on forget the last pair we were just looking at. As you get through expansion right here, right? We're still working towards this expansion. If we're expecting the 1 hour to run, we're still working towards this level right here, right? So as you get the confirmation coming through right here, because this is still lower, you could buy right here and control your risk below that expansion level as you get up and start holding above. So there's your risk. Enter, say, up here by the time you get up through, and risk right here. Because the facts are, if this is going to stay intact and keep trending, it's going to respect these levels as it comes through, as it did right here. If you're setting in this trade, see how it came down, respected this level. That's a clue that the trend is intact. There you have it right there. And it's not going below that level. That's why the expansion level is the most important line on this screen. It's giving you the framework that is going to say, is it for me or is it against me? And then that's the way you leg into this trade. You get up through. This is difficult, but if you're ultimately what you're counting on is the follow through of the hour. That's what you're really counting on to put you in the money. And the closer you are to the point of origination of the last expansion, the more you can count on the follow through. The farther you expand away, the less and less you can count on the follow through. So this is still, you know, in this situation, you're early to a rotation, you're right here. There's a good chance we could come up through this level right here, taking the macro perspective, getting into that trade, buying right here. This one may be worth a hold, even though you could see it got held up on this line. So we push through and then see the wicks of these candles right here are level with this expansion. It's trying to beat the door down, and then boom, it emerges, and you've legged into that. But either way, you're trying to get a strong position that, like Shane said, the closer you are to the decision point, to the expansion lines, the framework, the tighter risk you can have. And then when you control your risk and you're not jumping in like everybody else, as you're getting the ultimate confirmation, you're getting the worst trade placement that has a possibility of going back on and reversing on you. When you have a strong position, you know you're at the decision point. If it holds above, great. If it goes below, you have a very low risk. So, you know, it's something that you guys just gotta continue to work through and get experience with. So, I know I'm getting a little long-winded on this one. I'm gonna take probably one more question, Shane, if you want to, or if you've seen anything come up that we should address. But we'll do one more question, then we'll probably wrap it up for you guys. And I apologize if I haven't got to your questions. Again, sometimes, especially when we start going around, I'll get like 30 questions at once, and it's hard to get through everything. So you guys can always send your questions to support@tradeats.com. We're more than happy to help you guys that way as well. So let me take a look. I'm going to try to find one more good question, and then we'll probably wrap it up.
There is one comment that I wanted to make. For those of you that are, maybe not trading the hour into the 5 minute, or whatever time frame you're trading, all of this stuff applies to any time frame combination that you have. It's going to be exactly the same outside of your money management. So you might want to change that because that what could be 5 pips on the 5 minute to the last expansion, maybe 20 or 30 on the hour chart into the daily. So you just want to adjust your money management, but it's all the exact same things. It just plays out a little bit slower on the larger time frames. So yeah, everything that we're talking about here is, I mean, if we went and hid the hour tag and the 5 minute tag at the top, everything is exactly the same. So I just want to make that little comment.
Yeah, we got one question here from Thomas. And I'll just address this one. We'll probably do one more question, but the difference between a Heiken Ashi candle and a standard candle is that the Heiken Ashi candles, the reason why I've always gravitated towards them is because they show us a much smoother and accurate representation of the market phases. And also they're way less noisy. If you're trying to stay in trend and have a directional bias, which is part of the edge of trading, it's about trend trading. When other people think a trend is over, you're still in trend and you take their money. That's it's kind of similar to, for the lack of a better analogy, we'll go to a roulette wheel. In the game of roulette, you have basically half the board is black and half of it is red. And you could honestly, if there was no table limits and you had the bankroll, you could always win 100% of the time, because the probability of the ball landing on red or black is almost 50% minus the green square. There's like, I think, one green square, I'm not sure, maybe two, but basically it's almost 50-50. So if you have, let's say you have $1 you put down on black, and if it lands on any black square, you're going to get back $2. You're going to make 100%, right? So as long as you double any, I don't care if you've lost $100 betting on black, as long as you put down more money, you're eventually going to cover your loss. It's called martingale strategy. There's people that have tried to do martingale automated systems and everything. The fact is that the markets do go, or that even a roulette table can go 16, 17 blacks in a row, and you could literally be down 100 grand. And the tables have a table limit, so you can't go over the table limit. Eventually, you'll get blown out. That's why it doesn't work ultimately. But in the markets, there are no limits, and I'm not suggesting you do martingale and layering in. But what I'm telling you is that just like roulette, how you can go 16 blacks in a row, you might think, how can that even happen when the board is 50-50? And the facts is that it trends, and even more so in the markets trend. So if you know that your higher time frame is long, then you're only conditioning your mind to take long trades. So you just want to go, I'm long, I'm long, I'm long, I'm long, I'm long. And what contributes to you holding that directional bias is the stability of the charts you're looking at. And so going back to the original question, the Heiken Ashi charts show a much stabler view of trend direction by just simply down to the point of holding the candle color. I know that they lag a little bit on the turns, but overall, for trading a trend trading strategy, when a standard candle chart would be flashing different colors and going sideways, a Heiken Ashi chart will keep you long or keep you short. And then you will, instead of getting thrown off feeling like, oh, I feel like my higher time frame's done, you still would have been like, no, it's still smooth, it's still green, I'm still long, and then boom, you're in the trade for that next big move, because you have that stabler view of trend. So that's a reason why I've always gravitated towards Heiken Ashi charts. I think that they're just better, and the less noisy causes you to change your mind less, and the less you change your mind with your methodologies and what you do, the better you're going to be as a trader. Change is the enemy of traders. Changing systems, changing timeframes, changing currency pairs, change. You're going to be stuck in the never-ending cycle of system development if you're constantly changing. So you want to find something that's solid, something that doesn't change, something that has a stable framework. That's what ATS is supposed to be. And you just get really good at playing the game with it. You know, it's like working on a golf swing. You know, you just practice.
Hey, wait, I was gonna say we're getting a lot of comments about Euro Yen. Could you switch back over to that so we could see that trade? Sorry about that. Sorry to cut you off.
Yeah. Let's see. Okay, I think
We
entered
originally took it on the 4 hour and the 15, yeah.
Yeah. So 4 hour and the 15. Okay, so I mean, what did I say? I entered the trade late, but remember, this was just for educational purposes, and I am hoping that if you guys are taking this trade, you're doing it risking, you know, it's your business. We don't get into that with you guys. We're going to give you the piece of software. You guys are responsible for what you guys decide to trade. But for learning purposes, we're at the decision point, right? We had a relative, my entry point kind of sucked, honestly. It should have been a little bit lower than that if you're doing it, but either way, we got what we're working with. So now we're at the decision point. What do you do? Well, you're in the money, so it's showtime. What needs to happen for this to really be a big winner is we got to get through that white line. Right here, we're getting hung up on it right now, and that's no surprise. That's usually what happens at these lines. So right now, you're baking in the trade. Now, scenario one, from this point, we start getting a strong reaction. You start getting an aggressive red candle. I'm probably going to close the trade at break even or even a small loss, because I would have rather had my trade placement down closer to here, but you know, I didn't. So, you know, that if I see a strong reaction off that, you know, I'm definitely going to think twice about it, because there's no sense in being in the money and then watching it go all the way back to here. You know, I'm not going to use this original stop level anymore, because I've gotten progress. It's either going to perform or it's not. So that's scenario one, is that we get rejected. It comes back through. Because my trade placement isn't that great, I'm probably getting out at break even, and I'm going to forget the rest of this opportunity. I'm done. Wait for a whole new setup, whole new higher time frame setup, everything. Just walk away. But scenario two is that we get aggressive movement. Boom, we push through, and you'll probably know here pretty quick. We push through. Now guess what? Now we're in profit territory. Now what needs to happen? We got to now hold above this line, and we got to attack this line. That's stage two of this trading idea. So stage two, if we get through stage one, we get above this line, then stage two is how is it generally expected to perform? We hold above, we get up to this liquidity line. Stage three is it going to be a big runner or not? And that's, you know, that's finesse. I would say if you get above this active high right here, see if you don't get an aggressive move, and see just how the price action is. And you know, you generally want it, if it's going to use this liquidity line to push the market, you really don't want to see too big of a reaction. There may be some reaction, but if it's swimming around up here, at this point, you're in the money. You have bought the right to explore the trade. But that right only comes from having a strong entry point. If you're entering right now, you know, there are some traders that I have that will buy once you get up through this, because they know, okay, I feel like I'm going to get in the trade, and then they'll just control their risk right below the expansion line. You could do that, but you guys see that going off the basic strategy, the real entry point was the stronger entry point was down here. But this is, you're just interacting with the framework. These are the sensitive levels, and they're going to tell you the story. If we get a reaction off of this, this is probably going red. You can see that this candle is already getting smaller, right? It's showing you that this is going to be an extended pullback. And, you know, at that point, you'll know right here. You're going to know. So that's pretty much, I mean, the way I see this going down. And this is it. It's all the whole 90. I know I take a lot of flack for putting that dumb video out that said 90 to 95% win rate. What I should have said was 90 to 95% in the money rate. It was my mistake. But honestly, I put that video out so long ago, I really wasn't thinking about it. I thought, hey, this is a catchy title. I'm just going to put out somewhat of a clickbaity title, but back it up with good information. And I think that, you know, a lot of you guys have seen that video. I think it's, you know, it has 1 million views now. People seem to like the information. You know, I was just trying to give my best on it, but that when I talk about the 90 to 95% win rate, I should have said in the money rate. That's what we're trying to do with ATS. With the basic strategy, we're trying to get you in the money with a strong position. If we can get you in the money, and it all starts, the win rate comes with accurately understanding here where you are in the phase of your higher time frame, but getting you into the money affords you choices. When you have those choices, now you're not in a weak position, and your pain threshold isn't going to be pushed as easy because you're holding a much stronger position. Now you've got, even if this goes sideways, you're not going to really care because, you know, you still are down here for your entry point. So you're getting into the money just exploring if it's a good trade or not. So you have the potential to take 2, 3, 4 pips and be wrong still about the overall direction. I hope you guys understand. That's really what we're trying to do with the, you know, with the methodology and you know, and the basic strategy. So anyway, I think we're going to probably wrap it up there. That's what I think about this trade. If you're in it, you're at the decision point. So it'll either act for profit, for loss, but either way, you got a relatively low risk. One thing you do got to take into consideration is that we are getting late in the session. Pretty much, if this thing doesn't start performing, you know, in the next hour or so, you very well may get a 40, 50 pip spike out of this. And at that point, you've earned the right to ride it into Asia and see if you know, it's going to keep continuing. But if it doesn't show you any fireworks here, like in the next hour, I'd probably just dump it with a little profit. It's better to not hold trades on a 15-minute or a 5-minute time frame through the reset of the markets going into Asia and London. You know, if you're not significantly in the money on a trade, I'd leave it alone personally, but it's up to you guys. So anyway, that's what I think on that one. Hopefully you guys got something out of the webinar today. Really appreciate you guys getting on. We're getting a lot of support. I don't know if it's due to just the whole coronavirus thing, people being at home or whatever, but we've had some awesome participation in the webinars. I'll tell you guys, normally we usually have around 40 to 50, and we've been getting usually around, it changes, we've been getting almost 100 people on the webinar, which is pretty cool because, I mean, we've, you know, it's, you know, it's cool. It's cool to have the participation. So I really appreciate it. And again, I apologize if we didn't get to your guys' comments. It's just really hard to filter through everything. But hopefully, if you watch the older webinars, you'll notice that it's pretty repetitious. We talk about the same things over and over again. All it's going to come down to is you guys sticking with the methodology. That's really all it's going to come down to. Stick with the methodology, build experience, understand it's a long distance race, you know, that's going to be what pays off in the end. So, all right, guys, thank you so much. And we'll plan on seeing you guys next week, Tuesday at 10 a.m. Pacific Standard Time. Everyone have a great day, afternoon, evening, wherever you are, and we will see you then. Thank you.
You know what, real quick, I wanted to throw out there's a few questions about the software. We're going to be sending out an email here within the next week or so with a little bit more information regarding the software update. So it's going to be coming soon. We're doing some final tests on it and everything, but it is well on its way. So just wanted to throw that out there for you guys. Anyways, thank you.